Ladies and gentlemen, good day and welcome to the Jindal Steel Limited Q1 FY2026 earnings conference call hosted by Nomura. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Jashandeep Chadha from Nomura. Please go ahead.
Hi, thank you, Muskan. And good afternoon, everyone. And thanks for joining the first quarter call for Jindal Steel Limited. I'll quickly hand over to Mr. Vishal Chandak, the head IR and strategic finance, and he'll take you forward. Over to you, Vishal.
Thank you very much, Jashandeep. Good afternoon, good day, ladies and gentlemen. I welcome you all to the Q1 FY26 earnings briefing of Jindal Steel. I have with me from the senior management team Mr. Sabyasachi Bandyopadhyay, Whole-Time Director, Mr. Pankaj Malhan, Executive Director, and Mr. Sunil Agarwal, Head Finance. Without much ado, I'll hand over the phone. And Mr. S.K. Pradhan as well, Mr. S.K. Pradhan, Head of Marketing on Flats. Without much ado, I will hand over the floor to Mr. Sunil Agarwal for the opening comments. Over to you, sir.
Thank you, Vishal. So, good afternoon, ladies and gentlemen. I welcome you to the Q1 Financial Year 26 earnings briefing of Jindal Steel. Let me quickly brief you on the global economic scenario. IMF, in its recent update in July, has revised global growth forecast for current year, calendar year 25 to 3% from 22.8% in its April forecast, reflecting improved financial conditions and improving certainty to the tariff regime as compared to previous quarter. China continues to grow well over their stated target of around 5%. The IMF forecast for calendar year 25 is 4.8%. This is partly driven by front-ending of the export to the US before the tariff come into force. However, the tariff related to uncertainty continues to linger on. Global inflation is expected to gradually decline from 5.6% CY24 to 4.2% in CY25. India's crude steel production grew 1% quarter on quarter to 40.6 million tons in Q1 FY26, while demand contracted 5% quarter on quarter to 38.3 million tons due to seasonal weakness and early onset of monsoon. Steel export declined by 4% quarter on quarter to 1.6 million tons and import declined 19% quarter on quarter to 1.9 million tons. India remained net importer of steel in Q1 FY26 for fifth consecutive quarter with 0.3 million of net imports. Chinese steel production continues to outpace its weak domestic demand, resulting in elevated export impacting price globally. China is currently running on annualized export of 116 million, highest ever, which has resulted in several countries taking measures to stem the low-cost import from China. Several countries have either imposed or increased safeguard or anti-dumping duties against Chinese steel ports to shield their domestic industry from unreasonably low price imports. Government of India introduced a provisional 12% safeguard duty on select steel import effective April 21, 25. The result has stemmed the flow of imports. The provisional duty will be effect for 200 days. During the quarter, domestic HRC and TMT price increased on a sequential basis. HRC prices were partly supported by the 12% safeguard duty on most of the flat steel imports effective April 21st, but corrected later due to weak domestic demand. TMT price opened on a strong note but drifted down due to the early arrival of monsoon and sufficient inventory in the system. Now let me start with the key quarterly numbers. Production during the quarter one was marginally down by 1% quarter-on-quarter to 2.09 million tons. Sales volume at 1.9 million tons, down 10% quarter-on-quarter basis on account of replacement of inventory after excessive drawdown in Q4 of FY25, which is the seasonally strong quarter. Consolidated gross revenue fell 8% quarter-on-quarter to rupees 14,336 crore on account of lower volume, partly offset by increase in the ASP. During the Q4 earnings call, we guided for saving of around $10 to $15 in our Q1 coking coal consumption. Our actual coking coal cost has reduced by $11 per ton, in line with our guidance. Consolidated adjusted EBITDA for the quarter stood at rupees 2,984 crore and adjusted EBITDA per ton stood at rupees 15,680 per ton, which is up by 35% on quarter basis. Consolidated tax for the quarter stood at rupees 1,496 crore, which is 36% higher than the adjusted tax on quarter basis. Strong financial performance was driven by higher ASP and lower input costs, including reduction in conversion cost. Coming to our debt profile, our consolidated net as at 30th June was 14,400 crore, which has increased by rupees 2,443 on a sequence basis, primarily on account of working capital build-up. Accordingly, net debt to EBITDA stood at 1.49 times at the end of the quarter. We reiterate our commitment to cap the net debt to EBITDA at 1.5 times, underscoring our position as one of the strongest balance sheets in the industry. On total capex in the quarter stood at rupees 2,226 crore. Out of our total announced capex of rupees 47,043 crore, we have spent rupees 28,150 crore till 30th June 25. On mining front, we have won Roida 1 iron ore and manganese block in Odisha. This block has an EC capacity of 3 million tons per annum and estimated reserve of approximately 126 million tons. The company has already started extraction of iron ore from this mine. We plan to extract around 1.6 million tons in FY26 from this mine. I am pleased to share that we have successfully commissioned our first 0.2 million ton continuous galvanizing line at Angul. This makes an important milestone in our journey and reinforces our commitment to deliver high quality value-added steel products to meet the evolving needs of diverse industries. As informed previously, the commissioning activity of Blast Furnace 2 have already begun with the lighting of 3 gas stoves in Q4 FY25. We are on track to deliver the first hot metal from Blast Furnace 2 in this month. Rest of the project, including BOF2 slurry pipeline, SBPP, are progressing well as per scheduled timeline. We expect the slurry pipeline to be commissioned during the current fiscal year. For Q2 FY26, we expect the consumption cost of coking coal lower by around $5 per ton. The iron ore costs are currently flattish on quarter basis. Domestic steel prices are currently lower by 5 to 7% compared to Q1. While prices are soft currently, but the early indicators says that the possibility of turnaround soon. However, it is a little early to talk about how Q2 step up. With this, I open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah. Hi, sir. Good afternoon. Am I audible?
Yes, you are.
sir.
Yes.
Yeah. Hi, sir. Could you explain the volume reasons for volume decline on a year-on-year basis? And given the earlier guidance of 8.5 to 9 million ton, with Q1 volume sharply down, is the guidance still remains, or you look to cut down on the same?
Sevi sir?
Yes, Vishal, I was going to. Good afternoon. Hello, everybody. Thank you for joining. From our standpoint, production was broadly stable, quarter-on-quarter basis in the first quarter. Sales volume was certainly impacted by 10%, but that happened because of the early onset of monsoon. Also had an inventory build-up. Which certainly will get liquidated over the entire course of the year. As far as guidance towards the production and sales for the balance of the year and for the full financial year, we remain on course and we remain committed to those numbers. Thank you.
Yeah, thank you, sir. What was the utilization in this quarter?
Utilization in terms of?
No, production utilization, which you share every quarter.
In this quarter, capacity utilization you are asking for?
Yeah, correct.
Yeah, so we were roughly about, I would say 90%, 92%.
So, can I take this question?
Yeah, Sunilji.
Yeah. In our basically Raigad plant, our capacity utilization was 95%, and Angul we are roughly around 84%. On an average, we can say that's a blended 90%.
Okay, because March you had mentioned capacity utilization of 85%, and from there sequentially volumes are down 1%. So surprising, how are we saying utilization is close to 90%?
So I think basis
The audio is not clear. Can you please repeat the question?
I'm saying in March quarter press release and presentation, utilization was mentioned for company at 85%, with production numbers shared at 2.11 million. With 2.09, it should be lower than 85% because we mentioned closer to 90%.
So if I look at the capacity at this point of time, basis Angul and Raigad, without the additional capacities that are yet to come in Angul, we are broadly at about 90% of our capacity utilization. As Sunilji talked about, Raigad plant running at about 95% and Angul at about 85%, 84-85%.
Overall, we can say that last quarter it was 88% and current quarter is 87%. 1% production is down from quarter-on-quarter.
So Rajesh,
Understood.
Just to clarify, the capacity utilization is down by just 1%. Production remains stable. The decline is on the volume. Production remains stable.
Sure, thank you. I'll come back in queue.
Thank you. The next question is from the line of Amit Dixit from Goldman Sachs. Please go ahead.
Yeah. Hi. Good afternoon, everyone, and thanks for the opportunity. Congratulations for a good set of numbers. A couple of questions from my side. In the presentation deck, while you have mentioned on the slide 32 about the timeline of blast furnace 2 commissioning, which is Q2 FY26, is it possible to mention the timeline of BOF2 as well, when it is expected to be commissioned? It is undergoing pre-commissioning test, but a commissioning timeline would be great.
Let me take this question. You rightly said we are at a very advanced stage in terms of our blast furnace number 2 startup. Sunil mentioned a while back, we've all completed our stoves dry out, furnace dry out, and we're just trying to inch the last leg of the commissioning activities. Potentially sometime very soon we would be able to announce BF2 and BOF2. If I was to take that, it would be starting almost sometime very close to blast furnace 2 also. So we are at the advanced stage of commissioning at both these units.
So is it reasonable to expect that it would also be commissioned by Q2 or max by Q3?
BF2 we are expecting in quarter 2 of FY26.
Great, sir. That's helpful. The second question is, if I look at the P&L, the raw material cost per ton has gone down by almost 3,500, 3,600 rupees per ton. Now, while coking coal is one factor over there, just wanted to understand what are the other factors that resulted in such a sharp decline in raw material cost per ton, and is this sustainable? Some of these factors are sustainable going ahead?
So let me take this question, sir. So if you remember, sir, last time we have announced one item of around 231 crores. That has a effect of 336 rupees per ton. If we net off that, our net improvement is around 2,864. 336 is our captive consumption. If you reduce that, so net consumption is 2,864, and due to one-off item in the Q4 25, around 1,200 rupees per ton was the effect, and if we deduct that, so net impact is around 1,600 something per ton, which has come out of coking coal that we have already announced that we have saving of around $11 per ton during the quarter. So that has resulted in around 500 rupees per ton. And second is the PCI also. We have saved around 200 rupees per ton. And we have the saving in other items as well on scrap and other items that amounts to 900 and 1,000 rupees per ton. Hope this clarifies.
Yeah, sure, it does. I have other questions. I'll come back in the queue. Thanks and all the best.
Amit, this is Vishal here. I think the gap which everyone is looking at is we are missing out the point that in the previous quarter we announced a one-off of 331 crores, which was primarily residing in the raw material cost.
Yes.
Adjusting for that, balance has all declined in the raw material cost, broadly.
Yeah, sure. I mean, the bridge that was explained was quite good. Thank you so much for this elaborate answer.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Good afternoon, and congrats on a great result. So just on the Angul 2 commissioning, would you be able to also provide some guidance of volume that we can expect from BF2 and BF2 this year and next year?
Amit, that's a wonderful question, and our guidance remains the same intact, which Sabi also mentioned a while back. So we are committed to the guidance that we've stated at the start of the year, both in terms of production and dispatches, and we're very hopeful of hitting those numbers.
Okay, sure. Also, I was just seeing the presentation, the sectoral split of volumes. Auto seems to be only 3%, whereas flats is 44%. So I believe flats earlier used to be 20-25% range, which is your plates. So where does this increase come from then, if not from auto?
So Pradhanji, Mr. Pradhan, you can take that question.
Yeah, good afternoon, and we are most of the flats are coming from the new commissioning of hot strip mill, which we have done, and auto the ramp up takes some time. So we have started supplying to a lot of auto manufacturers, trial lots and all. But major volumes of auto we are supplying to a lot of value-added segments. So if you have seen, our value-added sale has gone up to 72% in this quarter compared to the previous quarter. So a lot of supplies to the very high grades of HR coils and HR coils. So that is what is contributed to increase other than auto, right?
Sure. And by when do you think the auto volumes could start to be meaningful?
It will start ramping up as we'll move ahead in the quarter on quarter.
Okay, got it. And just lastly on Tensa, did you produce any iron ore from Tensa in the quarter?
Yeah, we did produce, a bit of that coming from Tensa. But yes, Tensa is, towards the end of the mine life. And if I was to just share with you guys, the results what we've seen is minus Tensa almost for this quarter. The important part is to have our security done, and that's how we've gone ahead with Rider 1 mines. That would be actually compensating for the loss in volumes from Tensa getting into the future quarters. So Tensa did contribute, but a very minimal impact of that in this quarter.
Sure. And if I could just squeeze in one last question. You seem to be having the opening inventory of 0.2 million tons. So given that steel price has corrected a lot since the last quarter, could there be any NRV impact that would come in on this opening inventory?
Yeah, so certainly the effect of price reduction maybe, but we are maintaining that inventory from the quarter-on-quarter basis. And it will sequentially have the effect. Since now the prices are moving upwards, so we don't see much effect of that.
Sunilji, if I may add, in fact, on an aggregate basis, we do not anticipate any major impact at all. It's going to normalize itself, and we actually stand with a position of gaining a little bit from the price depressions that happened, and now regaining back its ground.
Sure. Thanks a lot and best wishes.
Thank you. The next question is from the line of Prithvi Jonsa from Anand Rathi. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question pertains to the net debt position. I believe this is the highest threshold level we have reached post 2021, right? And in the opening remarks, informed all of us that this is like 1.5x is the threshold. So it is fair to assume that this is the peak, and from here on going forward over next 2 to 4 quarters, we should see some debt reduction happening once the facility comes up on our street.
Sure. So we are seeing this as a peak because I have spoken that we have built up the inventory in Q1 for around 2,400, which is getting liquidated in Q2. So that will facilitate the reduction in the steel cash. That will improve our cash position. And now we are going to start the blast furnace and our BF2 that will start contributing. And we don't see this 1.5 breaching anymore. So we are at the top of the net debt to EBITDA limit that we have set.
Perfect. This is Vishal here. Let me reiterate over here. We had an inventory build-up which led to a working capital pile-on. We still have contained the net debt to EBITDA at 1.5 times. We have an accelerated payout because the facilities are commissioning. Cash flows are yet to come in. We have still maintained net debt to EBITDA at 1.5 times. 1.5 times is sacrosanct to us. It's a red line. We will not breach. I reiterate, we will not breach. So, coming quarter 3, the situation will automatically improve. And let me reiterate, in Q2, we have already crossed almost half of the Q2. We are still below 1.5 times. So I think the stress is beyond us now. We are looking for some good times ahead. Thanks.
Sure. Thanks, Vishal. Thanks. Really helpful. My next question is pertaining to the value-added side of the business, right? I believe the 72% is one of the highest in the industry. Usually the industry is around 60 to 65%. Now, number one, how confident are you to, ramp up from here on, say, 72 going forward? And just a very technical question, like what do you perceive as a value-added product? Is it after a certain conversion, what is termed as a value-added, or how do you perceive a certain product to be a value-added? Like what quantifies or qualifies it as a value-added?
So, could I take it from Vishal?
Yeah. Pradhanji, please go ahead.
Right. So, good afternoon. So, value-added in our case, see, category to category, it's much different. But then, whatever as a, if you take a thumb rule or take a benchmark, then anything above 350 MPa strength or value-added in plate. In HR coil, we are most of the high carbon, medium carbon, different grades. So it is the grade which defines whether we treat it as a value-added or not value-added, and the jump in realization. These two parameters we consider when we're deciding whether the product we will treat is value-added or not value-added, and it's consistent.
So,
can I add to that, Sushil?
Yes, sir.
So in plates also, what we do is typically we got a heat-treated segment, which is absolutely high-grade plates, which is getting into a very specialized sectors like defenses, automobiles, and even high-end of construction bridges. One of the good examples is Chenab Bridge that we did. Then, of course, the value addition that we give to the customers in terms of the solutions, which is largely coming from the fabricated structures. Then some high alloy wire rods, all these, and even the large size TMTs. We are the only company making 50 TMT. So these all falls under value-added, offerings from the company.
And the second part of the question was whether the 72% is sustainable, considering that the industry is operating somewhere around 60% range. So in this quarter, what has changed is since we are ramping up HR coil facility, and we are not with the fully utilized level of HR coil. So our focus is entirely on getting the best out of the asset, and that's how the very high volume concentration of value-added products we are making in our order strip mill. Okay.
Sure. And so if I may just use in a very quick one, just wanted to get the percentage of longs and flats this particular quarter.
44% is, I think, our flat, and 56% is long.
Sure, thank you. And I'll join the queue. Thank you so much.
And Sushil, if I may quickly add on that, points that you are making, that very re-geared and shifted focus even in Raigarh plate mill to produce plates, along with the furnace normalized and the upcoming facility of HTC, which is about to commission here, will certainly help us, all of us, to not only retain the value-added percentage, but also add up.
Thank you so much. I'll just join the queue.
Thank you. The next question is from the line of Rahul Kumar from Vakharia Capital. Please go ahead.
Yeah, hi. Actually, just a question on the industry in general. What has been the trend in the HRC imports from China to India after the input BIS norms on the input materials as well? Let's say in the month of July and August. How has it fared?
Vishal, I'm taking this question. So Chinese imports has practically stopped now, and except for some advanced license imports against advanced license. Two factors. One is the Chinese prices improved by roughly around $50 in last one and a half months time. So that has made the price almost unviable for them. Today, in fact, Chinese imports are at a premium to domestic prices. Okay, so that is one, and also the QCO order and melt and pour strict enforcement of that has impacted the imports. from China. Going forward, we are not seeing China as a major threat directly, but indirectly it may have an impact. What you are looking at, India is becoming a net importer for fifth consecutive quarter, right? Our exports are very low. So in the international market, we are not able to compete because of the Chinese factor. And Chinese exports, it's an all-time high. This year they are roughly exporting 9 to 10 million tons every month. So that's having an impact globally.
Okay. So let's say, theoretically, hypothetically, if the China HRC prices go down, would these BIS norms, because of these BIS norms, the imports will still be very low?
Yes, it will have an impact. It is having an impact. The low quality or inferior quality imports, which used to be a big threat to Indian players, have started coming down, and government has taken a very, very positive step in that direction.
Okay. That's all. Thank you.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. This first question on the projects, while you mentioned BAF, BOF, and slurry pipeline, just wanted to get an update on some of the other projects like the QNT line, color-coated galvanized, and also in the railway rakes that you were looking to acquire. And tied to that would also be that there was a news report earlier, a press release by government that JSPL has been selected for financial assistance incentive on the 2 million ton coal gasification. You didn't understand, is that a new coal gasification plant? Because you already have excess, seems like you already have sufficient coal gasification at Angul right now. So just wanted an update on projects and also this coal gasification before I move to the raw material question.
Okay, let me have this question. You started with the coal rolling mill. We have already commissioned 200,000 tons of galvanizing line. This is the first from the stable of Jindal Steel. We'll continuously be adding a lot of lines getting into this financial year. The next in line, we are expecting our color coating line, which should be there by end of quarter 3 this financial year, and then of course 2 more lines which we would be adding, our galvanizing line and color coating line number 2. So both should be with us in quarter 4 of FY26. Talking about some other projects, ranging from say slurry pipeline, we've already given an update. We continue to run fast on our steady speed over there. The major bottlenecks are behind us now, and our guidance remains the same, what we've given before, in terms of completion of the project. Hello?
Yeah. I think, Satya, you have a very long list of projects for which you are seeking an update. I would like to take this offline because in the interest of long queue behind us, we can talk about this offline.
Sure. So second question on the raw material cost. You just want to first on Tensa. It seemed like Tensa had some reserves on the boundary. So I was under the impression initially it can sustain to 2028. What is it now? End of life, and also the 1,000 rupees per ton raw material cost saving that came from others. I think you mentioned scrap or some other apart from coking coal. Is that what was that? Is that sustainable? The non-coking coal related cost savings that you saw in the quarter.
Yeah, the other cost is sustainable. These are on basically some. I always spoken that this was due to one-off around 1,400 rupees per ton in Q4, and other savings that I spoken that we think that is sustainable in future as well.
Okay. And
so we are operating on the Tensa is already effect of Tensa is there in Q1, so we have not taken much from Tensa. Only 0.13 million tons that we have expected in Q1, so that has hardly any impact on the Q1. So we think that whatever the saving is there, we will sustain that in future as well.
So, Satyadeep, if you look at our results and the opening remarks in which Mr. Pankaj Malan also mentioned the minimal amount of intake from Tensa mines. So I don't think even if you discard the effect of Tensa mines, the results are broadly purely operational on that front.
Can I add to that, Vishal? I think we spoke about Tensa. Tensa, of course, got a minimal impact onto our quarter one results. Mostly it is backed by some kind of, improved value in use items and operational excellence, which has actually led us to cut down our cost. And going forward into quarter two, of course, we all know this is a seasonal quarter, and of course there are monsoon challenges with any steel company. But we are very hopeful of getting back, to our, sustained position of these operating excellences, getting into the subsequent quarters also.
Okay, thank you so much.
Thank you. The next question is from the line of Sumangal from Kotak Securities. Please go ahead.
Yeah, good afternoon. So my first question is on thermal coal. Just want to understand what was the mix in 1Q and how are we benefiting from more and more captive coal, and how is it going forward in the coming quarters?
Let me take this question. Utkal C continues to be performing well for us. Quarter one, if I was to say, our 95% of the thermal coal came out of our own mines. We continue to have some FSA, small amount of that with the MCL mines. Getting into the subsequent quarters, we've already announced that Utkal B1 is expected to be on track in this quarter itself. So we should be able to actually meet our coal requirements from our own mines getting into this financial year.
I understand. And sir, what would be a delivered cost or at least comparison with linkage coal and e-auction versus captive?
This is a very specific question. I don't want to take that. But yes, there is a delta of around 3 to 4%. That is what I can say as of now in terms of using our own coal versus the bought out coal.
Okay. And so when do we expect Utkal B2? Any timelines there?
So we are already there. It's being a monsoon season and there are some delays, but we are expecting the coal to be with us start of quarter three.
Utkal B2, I guess some approval.
B1, I mentioned about B1.
Okay. So any update about B2? When do we expect? I think that's the last mine in our portfolio, right, where we are awaiting approvals.
B1, we've set our own priorities as of now. So we're working on one by one. I think B2 definitely is on our cards, but we'll let you know.
Understood. And just one last question on commissioning of BOF 3 and DRI 2. Where are we on the timelines?
So on DRI 2, of course, that's one project which we've already announced our revised timelines, which is into FY27. BOF 3, we remain committed to completing this financial year. That's quarter 4 of FY26.
Understand. All right. That's it from my side. Thanks.
So Mangal, just to add one more point on the coal portfolio. Gare Palma 4/6, Utkal C, Utkal B1, Utkal B2. These are the 4 mines of which we have spoken about. We have recently won Sardapur Jaltap coal block as well. So that has a geological reserves of about 3.2 billion tons. It's a partially explored block. And over the next couple of years, we are going to fully explore it and then announce what is the extractable reserves from there as well as the annual EC limit. Maybe that is something that you would look forward to in our next round of expansion exercise.
Got it.
Thank you. The next question is from the line of Pallav Agarwal from Antique Stock Broking. Please go ahead.
Yeah, good afternoon, sir. So I just want to understand the strategy on captive coal, because you mentioned that you're already sourcing 90 to 95% captively. So what are we going to do with the coal from the additional coal blocks? So is there some element of commercial sale as well, or those are for our captive power plants?
These are going to be for our captive power plants. We have almost stated that we are starting Unit 1 of our Shri Bhumi power plant this quarter itself. So as and when we are going to keep adding our power units, we'll continue to ramp up our coal mines.
Sure, sir. And you also, provided the breakup of the coal sourcing. So is it possible to share a similar, sourcing for iron ore? How much was from captive and external sources?
I think we can take it offline. Vishal can give you the numbers. Vishal, you can take it offline.
Sure, sir.
Sure. And so just lastly, I mean, just to understand, the difference between the console and standalone EBITDA. So this would mostly be from Jindal, Odisha. I mean, I'm assuming the overseas coal mines would not have contributed too much to the EBITDA.
Yeah. So this is I will take it, Pankaj. So this is mainly from the Odisha project that we have started. Mainly from that.
Sure, sir. I mean, it would help us, because this is ramping up. Maybe you could get some separate brief, summary of the production and profitability that would help us in our modeling purpose. So, just a request going.
Certainly, going forward, when we'll start the production from this new project, we'll give separate if required.
See, Pallab, the way you should look at is, Jindal Steel India is an entity that you should model in your models as well. Because if you start modeling between Jindal Steel Odisha and Jindal Steel Limited, there would be a lot of confusion between the transfer of material from one plant to another. So you should avoid that. Just build in a single model. That would help.
Yeah, that would help. But just the financials and the annual report would be for standalone. So for modeling purpose, I think we would do that. Yeah, thank you so much.
Thank you. The next question is from the line of Pratik Singh from DAM Capital. Please go ahead.
Hey, hi. Thanks for the opportunity. Just to get a sense on pricing, in the opening remarks, I think Sir said that prices right now are around 5 to 10% lower, which I assume he would be talking about the trade prices. So given a very high share of value-added products in our mix, is it a possibility, like we have seen this earlier also, that while the trade prices fell quite a bit, but our realization did not fall that much in one of the quarters, I think around 2 years back. So is it a possibility that the fall that we might see this quarter would be much lesser than what we are seeing in the trade markets? Is that something which we can assume?
See, what the point which you made about our exposure to trade and our exposure to OEM is absolutely right. And since we have a very high proportion of value-added steel, value-added sales, the elasticity of value-added prices on value-added is much lesser as compared to the non-value-added or trade type of steel. So you are absolutely right. The impact will not be that high as it is on the trade level prices. And that has been a strength of Jindal Steel, and that what you referred, what happened a few years back, so that holds true now as well.
Understood. And just a bookkeeping question, otherwise I'll take it offline. Can you give us the split of the acceptances, revenue, and capex?
I'll take it offline.
Sure. Thanks.
Thank you. The next question is from the line of Kamlesh from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity. So, if I see this particular quarter, we had a cash profit of roughly around 2100 odd crore, and if I see this one, we had sold shares from the ESOP trust as well, which I believe would be around 500 odd crore. So if we take it together, so 2600 crore of money which we had from the operating cash flows plus our ESOP, and even if we adjust for the capex which we have done in this quarter, so the debt increase is roughly around 3,800 odd crore, which looks very significant compared to last quarter. I know that there is an increase in working capital. Even factoring that working capital increase, it seems very high. So what are the nuances in that? Because you had provided the bridge, but that bridge really doesn't help because it's just a change in the debt and the ultimate resultant figure is the change in cash and cash equivalents.
Kamlesh, can you please repeat the question?
So I mean to say that why there has been such a sharp increase in debt quarter-over-quarter of 3,800 crore rupees, and given the fact that we had such a strong cash profit generation of 2,100 crore in this particular quarter and 500 crore of realization from the sale of ESOP trust shares.
Yeah, Kamlesh, basically, if you see, our EBITDA earning basically moved to working capital, which I have already explained that our working capital movement is around 2,900, and we have earned that. And whatever the total debt, net debt has increased, that is mainly gone to the capex side, which is 2,226, and balance around 700. We have done some prepayments of loan as well during the quarter, and we have paid the interest as well of the around 500 crores. I think that gives you an answer.
No, even factoring that, so it seems it would be better helpful if we can provide some bridge in the, like say, net debt flow, that how much was the operating cash flow and how much was the change in working capital. Just putting that change in cash and cash equivalents, so that anyway we can come out through if you provide net debt and for the last quarter and this quarter. And And lastly, on the TANSA, so can we assume 3 million ton run rate for the FY26, or how should we project it?
So, Pankaj, you can take the question.
Sorry, I missed this question. Can you repeat it, please?
So I mean to say that,
TANSA, we have mentioned that we extracted about 0.13 million tons in Q1. It's at the end of life. So I don't think you should build in that high number in your model while looking at overall profitability for the year. Okay. Secondly, on the breakup that you asked, I think we can take it offline.
Thanks a lot.
Thank you. The next question is from the line of Tushar Chaudhary from Prabhudas Lilladher. Please go ahead.
Hello. Am I audible?
Yes, sir.
Yeah, thanks a lot for the opportunity. Sir, I just wanted to know, you have been good update on projects. Just wanted to know the update on pellet plant to 6 million ton. Is it, when are you planning, and what is the update on the ramping up of, we recently commissioned 2-3 quarters back 6 million ton. So the utilization over there.
So let me start with the utilization of our existing pellet plant. Of course, it's going well. If I was to compare YOY basis, the production has gone now over 50% and more. So yes, the pellet requirement, as and when, if I was to share some more updates, which is one available over there in the updates, we could scale up our DRI production strongly because of our own pellet plant, ramp up in Angul. So that continues to be going well, and as and when BF2 is going to come up, we are very hopeful of sweating these assets very right. From a pellet plant 2 perspective, this pellet plant would be coming up in FY27. That's where we stand as of now.
Okay, thanks a lot. And sir, capex for next year will be similar to this year, 10,000 odd crores.
So, Tushar, in our capital allocation framework, we have mentioned already that on an annual basis, we'll do a capex of 7,500 to 10,000 crores. But for FY27, it's too early to give any guidance. We'll come back to you during the Q4 results for the next year's guidance.
Sure. Thanks a lot, and best of luck.
Thank you. Next question is from the line of Rajesh Manjudra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So just a couple of questions from my side. One is that we saw a drop in demand in 1Q due to the early onset of monsoon, so we had some inventory build-up. We are already halfway into 2Q. Are we seeing any signs of the inventory position easing? And are we seeing an early monsoon withdrawal plus festive season being preponed this year, adding to demand factors in 2Q, which will lead to drawdown in inventories and increase in the sales volume? That was the first question.
Sushil?
Yes. So this time the monsoon has arrived a little early, so the demand season started tapering down. The monsoon effect started somewhere in the month of June, but then we are in the month of August now, and we are already started seeing the sign of revival of demand from the construction side. More importantly, there are some lead segments which indicates that how the demand is going to unfold, something like yellow goods, something like construction equipment. We are seeing a very, very strong demand coming from these sectors now in this month, which indicates that the coming quarters, the demand will be extremely good and this impact will be, completely wiped out, and we are looking at good demand quarters ahead.
Right, so we can expect some kind of inventory easing in 2Q itself.
Correct, 100%. Yeah.
Okay, yeah. So my second question was on the new blast furnace commissioning. So what should we model some kind of losses at least in the first 2 quarters of the blast furnace ramp up before we reach some kind of stabilization levels, and that's somewhere in FY27? That was my question.
So we just spoke about our quarterly numbers. Most of you guys said they are wonderful numbers. The company remains committed in terms of the operational excellence, and it would be too premature for me or anybody else to speak on this, but we are committed to make sure we sustain our numbers getting into the subsequent quarters also.
Okay, thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. Ladies and gentlemen, as that was the last question for the day, I would now hand the conference over to the management for the closing comments. Over to you, sir.
Thank you for all of you. As we look at financial year 26 is shaping up to be the defining chapter for Jindal Steel. With the commissioning of major facility, blast furnace, BOF, SBPP and other facilities, Angul is on track to establish itself as one of the world's top single-site steel production hubs. But our journey is not just about expanding capacity. It is about strengthening the entire value chain, from mining to logistics to manufacturing to and sustainability. This reflects our deeper purpose, namely creating a nation of our dream. We are grateful for the continued trust and support of our stakeholders, and we remain fully committed to delivering our promises, responsibility, and sustainability. Thank you all for this call.
Thank you. On behalf of Nomura, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you. Thank you.